Software stocks have become ground zero for investors' anxiety over the possible disruption coming from AI.
Tech is the worst performing sector so far this year. Is this just a pause or a crack in the AI trade? Let's bring in Dan Ives, Managing Director and Senior Equity Research Analyst at Wedbush Securities.
So fast.
Dan, always good to have you. I know you're well known for saying AI
so
party
low.
is
So I think what's happening now is we're turning into a year that's going to end up like 2008. It's great for traders. I used to be one, and it's just getting started.
I'm about to explain to you why your tech portfolio is the color of a bright red strawberry this week, and you need to listen very, very closely to understand the current state of the market. The tech market has fallen in the past week. The S&P hovers and the Nasdaq drops almost 3%, but also hedge assets like crypto or silver and gold. Hedge assets are what banks use to hedge in the market when everything else crashes, looking for stability. But one thing remains: why? Why are top stocks like Nvidia, Amazon, Tesla, and Microsoft being outperformed by Verizon, Procter & Gamble, and ExxonMobil to great lengths? We all know AI has taken the world by storm in the past couple of years, overpowering a lot of software available to the public as it keeps advancing and making leaps. Keeping it simple, this devalues other software as it takes much more time and money to produce and maintain. The tech companies I talked about earlier are leaders in software, which was essentially a gold mine in the industry. As AI takes the podium, these companies begin to lose value. Something crucial to understand is that software is intangible. It cannot be touched or valued off physical properties. If you want to sell a house, it is a physical object with real materials that can be valued off physical properties. Software that companies spent hundreds of millions of dollars producing is now becoming worthless, which isn't a small loss. It's a catastrophic failure. The top 10 stocks in the S&P 500 now account for about 38 to 40% of it, which rely heavily on tech and software. This creates a very notable concentration risk if these companies begin to fall, which we are starting to see right now. A concentration risk is like putting all your eggs in one basket. That basket will be very full, but if you drop it, all the eggs shatter, not just one or two. Right now, the market is holding that basket over the edge of the Burj Khalifa with one hand, while the other one holds its new iPhone 17 Pro Max to watch TikTok. There is minimal diversification within the market. Other sectors cannot keep up because A, they also rely on software, and B, they don't have the weight to do so. Some people see this as a tech bubble, or coming from Sam Altman himself, an AI bubble. This is why your New Year's resolution to invest is like punching yourself in the dick. Amidst all the chaos, one thing remains strong: companies with larger amounts of tangible assets. Unlike an intangible asset, a tangible asset is something really you can touch, like the house example I gave earlier. Some examples would be companies concerning consumer non-durables, manufacturing, healthcare, and communications. These stocks continue to show strength while tech falls. These types of companies are known to be recession-proof as they provide goods for a baseline standard of needs in today's society and hold tangible assets. This doesn't mean recession-proof stocks won't fall during a recession, but they tend to hold up much better. With the S&P rebounding today after only falling a mere 0.6% last week, and the Nasdaq rebounding and falling 2.6% last week, this doesn't look that bad. But with that being said, last week we saw a strong testimony of the present concentration risk in the current market. Taking a look at the charts for recession-proof companies, it is clear they have been loading up for a bit of time while indexes hover. But why are hedge assets like precious metals and crypto continuing to fall? There is something that could be much deeper going on behind the scenes. The economy finally catching up to reality as it sits like a ticking time bomb. If you want that video, make sure to like, subscribe, and turn on push notifications. You don't want to miss it.